Hello one, hello all. This is the think tank from Let the Blight Tutorials. So from now on going forward, we are going to take a slightly different approach in terms of our videos. We created a poll on our WhatsApp group and we asked our members on the group as to what sort of information do they want on our videos, and they made it explicitly clear that they are looking or they want us to provide past question papers and do them live. So in an attempt to respond to their request, we are going to do exactly that. But our past paper questions or our videos going forward, they are going to consist both past paper where we do them live with you, but we'll also explain the logic behind the approach or the solution that we use, so that you can use this information in addition to the memorandum. So the topic that we are going to focus on is the most difficult topic in accounting, and it's going to be fixed assets. So we are going to be calculating depreciation on fixed assets, depreciation on old assets, new assets, and assets that were sold. So just take out your pen and paper and have a calculator with you, and I'll explain how to approach equation fixed assets and the things that you should look out for and what you should do. Because I believe that most of us, the problem is banayo when it comes to these specific type of questions is that there's a lot of information and we cannot categorize or classify them so that we use it to answer the question. So what's the approach? I love using flow charts so that you understand the logic when we approach questions as accounting students. So the first thing that you should take out from an adjustment or a transaction fixed assets is that you always look at the cost to see what's the cost of the asset, and then from the cost you ask yourself the following question: what type of assets am I dealing with? If I'm going to be dealing with vehicles, for an example, you are going to ask yourself, is this an old vehicle? Is this a new vehicle? Or is this a vehicle that I've decided to sell? Remember, when you decide to sell something or when you decide to get rid of something in accounting, that's called a disposal. So you can dispose an asset by selling it, you can dispose an asset by donating it, and you can dispose an asset, for an example, or you can write it off, for an example, if it caught fire in the premises. So you figure out the cost from the adjustment, and then from figuring out the cost from the adjustment, you ask yourself, what type of an asset am I dealing with? It's always very important for you to categorize or to separate new assets from old assets. For an example, if maybe you get a question vehicles, you are given an old asset, you are given an old cost and accumulated depreciation of old vehicles, and then adjustments, they tell you as well that a new vehicle was bought during the year. That means that under vehicles you have two types of assets now. You have the old assets, which was already there and prior to this current financial year, and then you are also going to calculate the depreciation as well for the new asset. So it's always very important for you to differentiate between old assets, new assets, and the assets that you decided to sell during the year. Why? It's because their timeline is different. The asset that stayed, an old asset must have probably stayed from the beginning of the year to the end of the year. A new asset must have stayed in the business from the time it was bought up until the end of the financial year. And then an asset that you sold, it means that it fell within the business from the beginning of the year up until the date of sale. So when you differentiate or depreciate for these different types of assets, it's always very important for you to take time into consideration So for an old asset, you are going to depreciate from the beginning of the year to the end of the year. So that means that the number of months here is 12 over 12. And then for a new asset, you are going to depreciate from the time you bought the asset to the end of the year. And so this one, you are going to depreciate from the day of purchase to the end of the year. And then this one, an asset that you decided to sell. So this asset must have stayed within the business premises, or must have used the asset during the current year from the beginning of the financial year to the date at which you decided to sell the asset. So it's very important to take time. It's very important to take time into consideration when you are dealing with the depreciation. So from there, you ask yourself now, which depreciation method was used? Basebenzise yiphi method of depreciation. If it's the cost price method, if the cost price method was used, or it's also called the straight line, if the cost price or the straight line was used, it means that you are going to say cost multiplied by the depreciation percentage. Okay, so the carrying value method is saying we should take the cost minus accumulated depreciation and then multiply by the depreciation percentage. And depending on when the asset was bought or sold, and then you should also include the number of months, and as discussed above. Time and price, guys. Time and cost, they are very important when you are working with the depreciation. I hope so far it makes sense. For us to be able to understand this now that we are doing, let's just take this example, and then so that you can apply the principles. So you are given this information now, and you are told that the information relates to the financial year ended 28 February 2022, and then they are telling us that we should calculate the missing figures from Roman figure 1 to Roman figure 3 on the fixed asset note. Remember, the fixed asset note tells you about the changes or the movements in the fixed assets of the business. So that means that here it tells you about the balance. The balances at the beginning, and then the changes that happened, and then here it tells you about the balances at the end, and it just tells you a story of the asset with how much have they changed, or what movements transpired during the year. So let's see what we are given here again. So here you are given under buildings, you are given a cost of 6.45 million, and then there's no depreciation on buildings. Remember, buildings appreciate in value. So, and then here you are also told that under vehicles you have a cost of 2.35 million, and then an accumulated depreciation of how much? Of 840,000. So for you to be able to calculate the carrying value, remember, carrying value is cost minus, so carrying value is cost minus accumulated depreciation. So in this instance, it means that we are going to say 2,350,000 minus 840,000. So izosinikeza how much? Izosinikeza this amount. So let's write here. So 1, carrying value is equals to cost minus accumulated depreciation. So the cost is 2,350,000. So minus 840,000, which is the accumulated depreciation, and this is going to give us 1,510,000. So this is the carrying value of vehicles at the beginning of the year, which is 1 March 2021. So let's go to our adjustments now. So under adjustments, you are told that there were extensions on the buildings that were completed during the financial year. You are also told that additional equipment was bought on 1 October 2021. And then you are also told that equipment is depreciated at 10% on cost. The method, they told you now, the method of equipment, which is depreciated at 10% on cost. And then the second last bulletin, you are told that the old vehicle was sold at the carrying value on 30 November 2021. And this is very important. So a vehicle was sold. So if you sell a vehicle, so how are you going to calculate depreciation? Let's go back. You are going to calculate depreciation from the beginning of the financial year to the day at which you sold the vehicle. So you sold the vehicle at 30 November 2021. Let's go back to our diagram. We said that if you sell a vehicle, you are going to calculate depreciation from the beginning of the financial year, and the beginning of the current financial year to the date that you decided to sell the asset. So that means that in this case, we are going to calculate depreciation from 1 March to 30 November 2021. 2021. And then you are given more information. You are told that the cost price of this vehicle is 252,000 rands, and then the accumulated depreciation on 1 March 2021 at the beginning of the financial year was 172,000. So we go back. Which method? Go back to the diagram. So we've figured out now that, okay, you are dealing with a vehicle that was sold during the year. So you are dealing with a sold vehicle, and then which method is used, and then you are told that the method of depreciation is what? The method of depreciation is the carrying value method. It means that for you to calculate depreciation for this specific type of an asset that was sold during the year, you are going to say cost minus accumulated depreciation times the depreciation percentage. So remember, we are still dealing with the vehicle that was sold. There's still a vehicle from the old balances of vehicle that we had. Remember, we have that 2.35 million. So that's the old vehicle class that we have. So let's work now with the vehicle that was sold. So asset disposal. So this is the sold vehicle. We'll have to calculate the depreciation account. So the depreciation of this vehicle that we decided to sell during the current financial year, we are going to say, okay, depreciation of this asset is cost minus accumulated depreciation. Then we multiply by the depreciation percentage as per the formula. But because we decided to sell this asset during the year, we have to consider as well what? We have to consider the number of months. So is the number of months during the current financial year divided by 12. So what do we have here now? We are told that the cost of this vehicle is 252,000. And then the accumulated depreciation near 1 March 2021 is 172,000. Then you'll multiply this. Okay, guys, I'm running out of space, so let's do this. So the depreciation is equals to 252,000 minus 172,000. So it's cost minus accumulated depreciation multiplied by the depreciation percentage. Let's see what they tell us. So we are told here that depreciation on vehicles is 20% on the carrying value. So that's why we are saying cost minus accumulated depreciation. Then we'll multiply by 20% here. So it's 20% multiplied by. So remember, this asset was sold during the year. So that means that it didn't stay, or we didn't use it for the full financial year, which means for the full 12 months. So we only used it from March up until November, and that's going to be 9 months. So it's 9 over 12. So it's 252,000 minus 172,000 multiplied by 20% multiplied by 9 over 12. This gives you 12,000. Okay. So this gives you 12,000. So that means that before we sold the asset, it depreciated in value. So it went down in value by how much? By 12,000 rands. And so this is part of the depreciation of the sold vehicle. And so now the next step on this vehicle that was sold, and is for us to calculate what they want, which is the disposals. And remember, on the fixed asset note, disposals are always reflected at what is called the carrying value of that specific asset that was sold. So now what we have now, so this asset, it has a cost price of how much? It has a cost price of 252,000. And then the accumulated depreciation at the beginning of the year was on the 1st of March. Was how much? Was 172,000. And then the depreciation now on 30 November is how much? It's 11. So 30 November 2021. And the depreciation for this year is how much? Depreciation for this year is this 12,000. And then, so we are going to have to find now the what? The carrying value. Carrying value 30 November 2021. This is going to give us, so we are going to say 252,000, which is the cost, 252,000, which is the cost, minus 172,000, which is the accumulated depreciation, and then accumulated depreciation on the 1st of March, which is at the beginning of the year. But this asset depreciated even during the year, and before we sold it, so it depreciated and it lost value here, 12,000. So we are going to say minus 12,000 this way. So this is going to give you 68,000. So the disposals at carrying value, so the carrying value of the asset that we sold, and it is 68,000. So so number 3. So number 3 is equals to 68,000. Okay. Number 3 is equals to 68,000. So we have found number 1, which is 1,510,000, sorry. And then number 3, which is 68,000. So number 2, how do we work out on number 2? It's a very tricky question, and we should be very careful when we are working with number 2. Okay, let's do it again. So there you are expected to calculate the depreciation of number 2. Okay. So let's start by looking at these two figures. So here, the cost minus the accumulated depreciation gives you a carrying value of 28,000. So what does this mean? And it means that this year, the accumulated depreciation from this asset should not exceed 28,000. Because if it exceeds 28,000, are you aware that you are going to have a negative cost? And that's not what we are looking for. So this is where you employ, or this is where you use the method A1 rand, and of having a carrying value A1 rand. And so this is what we are going to do. And so we are going to first calculate the depreciation of the old equipment. And so now we are working with equipment, remember. So sizocalculate a depreciation yale equipment yakudala. So this is the old equipment depreciation yakhona. Remember, they told us from the adjustments that equipment is depreciated at 10% on cost. So if an asset is depreciated at 10% on cost, we go back to our diagram, is the cost of the asset multiplied by the depreciation percentage. So the cost of the asset is how much? Is 640,000. So that's the cost. And then what's the depreciation percentage of this old asset? Is 10%. So we are going to say 6 depreciation is equals to 640,000 multiplied by 0.10. And this is going to give us now 64,000. And so this is the carrying value, this is the depreciation, is 64,000. And remember what I said. I said that the depreciation for this year should not exceed 28,000. And because if it exceeds 28,000, you are going to have a negative cost, or you are going to have a negative carrying value. Sorry, not a negative cost. You are going to have a negative carrying value. So we have a limit. And so that means that now, for you to be able to calculate, now a depreciation for this year, the depreciation must be limited, and must be limited to 28,000. Remember, the carrying value is equals to 28,000. You saw from the diagram or from the fixed asset note. And the depreciation that we found this year is how much? Is 64,000. So depreciation le yakudonyaka, which is 2021 to 2022, akumelanga ukuthi idlule kubani, akumelanga ukuthi idlule kwi-carrying value, which is 28,000. So that means that because we see that 64 is greater than, because siyabona ukuthi 64 uyamdlula u-28,000, which is the carrying value, what we do, we use the method of having a carrying value yemalini ye-1 rand. So that means that the depreciation for this year now, so the depreciation for this year, therefore, the depreciation for this year is going to be limited to the carrying value. So uzothi 28,000 minus 1 is going to give you 27,999. And so this is going to be our depreciation for the year. So that must calculate the carrying value of this asset. Let's say we calculate the carrying value. So the carrying value of this asset is going to be 64,000 minus, 640,000, which is the cost, minus minus the accumulated depreciation, which is how much? Which is 612. So minus the accumulated depreciation, which is 612, and then minus now the depreciation for the year, which is 27,999. So this is going to give us a carrying value ye-1 rand. And instead of, what if we had used this 64,000 as our depreciation for the year? And what if we had used, let's say, Besingazi? And let's see. So, 64,000 minus 6112 accumulated depreciation minus 64,000. Let's see those niggas. 640,000 minus 612,000 minus 64,000. Can you see that it's going to give you a negative 36,000, which is a negative carrying value? And it's going to give you a negative carrying value, and you cannot have a negative asset in accounting. So to avoid this scenario, here of having a negative carrying value, we should always make sure that the depreciation for the year does not exceed the carrying value of the asset. And I hope you understood the principle here. This was a very nice but tricky question if you don't know your theory. So I hope you understood. So the depreciation for the old asset is how much? Is 27,999. On number 2, they are looking for the depreciation. So they are looking for the depreciation for the year, so of the equipment. So we have calculated the depreciation. So we have calculated the depreciation of the old equipment, dang it. So we have calculated it to say is how much is 27,999. So now we need to work out the depreciation of the new equipment. So let's calculate the depreciation yale machine emisha that you bought. How do you know that you bought the new machine? We are told on the adjustments, additional equipment was purchased, and they told you the date. So remember, when you purchase a new asset, you are going to depreciate the asset from the day, the day it came into our premises up until the last day of the financial year. So go back to the diagram. We are working with a new asset. So when you are working with a new asset, you depreciate from the date of purchase to the end of the financial year. So in this instance, we are going to depreciate from, I think it's 18 November, is 1 October, sorry. So we are going to depreciate from 1 October to 28 Feb 2022. So let's work this thing out and then we are done. So we are going to say cost is how much? The cost of this new equipment is how much? Is 195,000, dang it. Here, it's 195,000. So this is 195,000 multiplied by 10%, which is the depreciation percentage. But this new equipment, we bought it during the year, so we need to account for time, which is the number of months. So if we bought it in 1 October, if it's 1 October, which means it had November, December, January, February. October, November, December, January, February, which is 5 months. And it's also 5 over 12. And it's going to give us 195,000 multiply 0.1 multiplied by 5 over 12. It's going to give us 8,125. So you are the amount of this nigga Zion. What's the total depreciation on equipment now? Total depreciation on equipment for the year is the depreciation on the old plus the depreciation on the new equipment. So what's the depreciation on the old equipment? Is 27,999. So add nale depreciation of the new equipment, which is 8,125. So the total is going to give us, so the total is going to give us 36,124. So that's it for today, guys. I hope that you understood everything that we went through. We are still going to maybe do one more question of fixed assets, because this is a very difficult topic for most of you, and the goal is to give you an approach and then do an example with you, so that uzokwazi ukuzenzela and also understand the logic on your own. But anything other than that, from the think tank and from the Blight tutorials, sithi makukhanye, lisedi.